Joining us right now to talk about what's next for the market and what the volatility means for the retail investor is J.J. Kinahan. He's chief market strategist at TD Ameritrade. Also, Kevin Nicholson, who's global fixed income co-CIO at Riverfront Investment Group. And guys, it's great to see both of you. J.J., let's start with you. What the heck happened yesterday? Try and make sense of this.
Well, I think, you had a few things. The 2 nights ago on Tuesday night, you had that really weak close. The momentum carried in sort of around the world. At the same time, you had Bitcoin and the cryptocurrencies getting weak. And, so we came into the day with the bad momentum. The nice thing is we held this 50-day moving average of 40.80, which, overnight last night, we also, it looks like at least on the S&P 500 futures, have gone down near that area. But we held it and rallied back pretty significantly. And in fact, the one thing I came away very encouraged by yesterday is we always talk about the weakness in technology with what the Fed may do, et cetera. I think you have to really bifurcate technology. What is the old school tech companies, the Apples, the Microsofts? I'll throw Facebook in there. What did they do? And they all rallied back yesterday to actually be positive. Now, I know some of the newer technology companies had a tougher day, but I think we really have to separate those two going forward. And in fact, a lot of retail investors will turn toward the Apples and Microsofts during times of trouble because they still believe in that longer-term story for those companies.
And maybe because it's like comfort food too, right?
Yeah, absolutely. And let's face it, they have performed. The buy the dip mentality usually starts with those kind of companies overall. And that was what I was most interested in seeing, and I'll be interested in seeing it again today. As we get down there, this 50-day moving average, as I said, that 40-80-ish area, will we continue to see people coming and buy the dip? Let's face it, Becky, it's paid off for years. It's like if I coached a football team, if I ran a play and nobody ever stopped it, I'd keep running the play. And that's kind of, I think, the thought process of a lot of investors right now.
Yeah, run it till you get caught. Hey, Kevin, I know in your title it says fixed income, but I know you look more broadly at equities and fixed income as well. What do you think happens after a day like yesterday? Does it make you more nervous? Does it make you think, okay, we're shaking out some things and this is a good thing? What's your reaction?
No, I'm not nervous at all. I think that, the market does not like uncertainty, and we have a lot of uncertainty right now. Obviously, with the Fed, the market feeling like the Fed may possibly be behind the curve. You have the potential for tax increases. You have the market concerned about meeting higher earnings expectations going forward. So you have all these things going on, but I think that it's the time for investors to really rebalance their portfolios. For instance, like in our shorter time horizon portfolios, more conservative, we just recently rebalanced our domestic equity position. We started the year with a 5% overweight, and that rallied to about a 7.5% overweight. And we thought that we needed to take some of those chips off the table because there was going to be this period of uncertainty as we go into these summer months. The market, like I said, is worried about inflation. And so I think the next 3 months are going to be very important to that. But I do think that there's opportunities when you get these types of pullbacks in the market.
Opportunities where? Just anything that's pulled back extremely? Are you talking about the pullbacks we've seen in cryptocurrency? Or are you looking at stocks in particular and thinking that there was maybe some babies thrown out with the bathwater?
We're looking more at stocks, thinking some babies were thrown out with the bathwater. One of the things that we see an opportunity is that as the economy reopens here, we have been, everyone has been really focused on, goods. But I think things are going to turn more to services, and that's going to bring the consumer back. We're really looking at the consumer because if you think about it, for the last 12 months or so, the consumer has either been paying down debt based upon, receiving their stimulus payments, or they have just been not consuming and saving money. And so we're looking to the consumer to resume that leadership position. And so we like consumer discretionary, but we take it one step further. We think that financials also have an opportunity here because banks are looking to lend, and they are beefing up their rewards programs and in order to entice the consumer. And we think that, the two together are going to be a good place to look going forward.
Shepard Smith here. Thanks for watching CNBC on YouTube.